Hello, and welcome to Spotlight On, the podcast that brings together business leaders, entrepreneurs, and experts covering a range of topics. I'm Nicholas Barton, founder and CEO of the Barton Partnership. We're an award-winning executive recruitment and consulting solutions firm providing permanent search and independent consulting services across strategy, sustainability and M&A, data and analytics, and transformation and change.
My name is Emily Farrow. I lead transformation and change recruitment in the private equity space here at the Barton Partnership. Today, I am joined by Oliver Lang. Oliver is a former management consultant turned serial entrepreneur with particular expertise in insurance, including former C-suite role with Europe's leading InsurTech company, WeFox. Now acting as a board member for startups whilst continuing to found, grow and sell further businesses of his own. He combines innovative thinking and business building competencies with extensive consulting experience and first-hand knowledge of corporate players. Ollie, thank you so much for joining me today. Could you start by sharing a brief overview of your career journey to date?
Sure. Thanks for having me on the podcast. Probably a very basic and typical career. I started with business administration, not a typical recruiting university that time for McKinsey or others, small university in Germany. But I spent a year in the United States, in Chicago, and there I've met a professor who at that time gave lecture to, I guess it was McKinsey consultants who went abroad for the first time. As you know, Americans don't usually go as often to other countries than the Europeans do. And so he kind of lectured first time abroad McKinsey consultants. And so he introduced me to McKinsey actually back in Chicago. And when I was back in Germany, they already knew about me. So it worked within the communication worked within McKinsey. And so they approached me. I did an internship with them and later joined them. Got sucked into banking first and their credit risk management, which was a topic at the time. And then through a merger actually between Allianz and Dresdner Bank in Germany, I got into insurance. And at that time, McKinsey didn't have an insurance risk management practice. They have these practices, industry and functional practices, and the intersection of insurance and risk wasn't there at that time. So together with a couple of others, I decided to build that within McKinsey. And so that's what we've done. Luckily, Solvency II came shortly after, and so it became a hot topic, but it was pure luck. So that was the McKinsey story. I did drop out of McKinsey twice to build 3 startups. Yeah. So they basically let me drop out, build a startup. And when I sold it, they asked me to come back. And I did once at least. Second time I didn't. But yes, that was the McKinsey story. And risk and insurance basically became my exit path as well. I was then hired by a insurance company called Convarium at that time, reinsurance company, later merged with SCOR. They were in deep shit, basically lost their credit rating and lost a lot of their business. And they hired me as chief risk officer. So clear path of the insurance risk perspective into the corporate world. Did that for about a year. Then we sold it to SCOR. And then I went back into company building, opened together with a friend, I opened we call it venture studio today. We didn't have a name back then. It was 2007. A venture studio in Frankfurt first in Germany, and then in Berlin later, also Germany. Then 2019 joined WeFox, not as a founder, but later, first as the CEO of the insurance division, and then as the overall CEO. Dropped out in end of 21, 2.5 years later. And now I hold a couple of board positions. I do a couple of PE deals for others, not for my companies. And I periodically co-found companies and later potentially sell them. Weird career, but...
So you spent the first 9 years of your career at McKinsey before venturing into the world of entrepreneurship, or actually really at the same time as well.
Yes.
What practical advice would you give to consultants considering a similar transition, and how can they leverage their consulting skills in an entrepreneurial context?
Well, that's a good question. I just met 2 friends actually last week. One said, it's good to be a consultant and then start companies because you get all these great skills. And the other person said, actually, consultants are the worst entrepreneurs. So I guess there's no natural route there, but a couple of strengths and weaknesses. And I'm not in a position to give advice. I realize that there's so many ways to success, but also to failure. I think what helped me is, you get into issues or topics very quickly. That's your basic job, right? You get an assignment, and within the first 1, 2, 3 weeks or so, you need to have a good overview over the problems, the issues, the topics. I think that helps a lot when you start a company. I also think that dealing with ambiguity, it's always easy said, but it's super hard, especially when you in a corporate career where everything is set up for you, like the next step. I think it's a bit hard in consulting where, projects can end early or be prolonged. And so the ambiguity you deal with in your consulting career, I think, is a bit higher than in the normal corporate career, which helps again in founding companies, because ambiguity will be super high for you. I think what doesn't help is taking personal risks. As a consultant, you're so far away from taking personal risks. I mean, you give advice to people who take risks, and typically they risk other people's money. And so, two to three steps away from taking personal risks. I think something you will need to learn when transitioning from consulting into entrepreneurship. I also think being the ultimate responsible person for things happening to your employees, their families, your customers, is something new to consulting. Because again, consulting means, you give advice to others and then they decide or might not decide. But, being the last resort, being the final person to give a call was difficult for me at the beginning. Fortunately, I started young, but I think that's the pros and cons for consulting. But leverage your strengths, also personal strengths. That's where I can't give you advice. For me, what's worked is I've always been very curious in some process details. I want to understand how things run. And so I typically dig deep in operational processual issues. At the same time, I've always found it very easy to process new information into, hey, how can this help make my business better? But that's just natural to me. I have a lot of weaknesses that I typically leverage to other persons, but I try to leverage those strengths. Or people call me, hyperactive. The positive thing is very energetic. I think negatively put, it's hyperactive. I try to use this to energize teams. You need to decide for yourself, where's your strengths, use them. Don't pretend to be somebody you're not.
Yeah, no, that's good advice. You have a successful track record, as you mentioned, of selling businesses to private equity funds. Could you share some of your insights on the key considerations for positioning a business attractively for sale? And what overarching lessons should aspiring entrepreneurs keep in mind during that process?
Well, that's a good question. And it's actually a very broad question, because you would think from the outside that private equity is a single industry, but it's, there's so many nuances to private equity. Some do growth deals. They need to grow companies that they purchase before selling them. Some do M&A, buy and build. Some are very operational and try to increase the margin of the business. Some do distressed business, so it's not a unified industry, if you want. So it's very hard to transport this in a single way. I think one thing is very important. If you're working in an industry and you approach or you're talking to a PE company, it's very easy to perceive the PE guys as stupid, because naturally they don't know your industry as well as you do. They know many other things, right? And so don't make the mistake of thinking they don't understand my business. How would they ever run my business if they understand so little of my business, right? They just have a different business model, but be sure they have a business model, right? They buy low and sell high, as you do. Their time in stock, their turnaround time is around 7 years. So be aware who you're talking to. Do your research of what their business model is. Do they buy distressed or growth or whatever? And then help them find their way. If you're talking to a growth fund, help them with ideas of how to grow your business once they own it, right? Because that makes your business more attractive to them and potentially the purchase price higher. If you're talking about with a fund that does operational excellence, so increase the margin, but not necessarily grows the business, then come up with ideas how you can make your business better. Maybe exit some lines of business or customer segments, add new ones. Be aware of who you talk to and then talk their language. What they probably always do better than you is the entire financial engineering. So typically they leverage your business. So that means they take debt on your business. What they need for this is stable recurring income, because that's what they lend against, right? Banks or other companies who give them debt money look for stable profits to repay the debt. So typically they will receive 5 to 7 times your annual EBIT or so, right? So make sure your annual EBIT is stable and not fluctuating a lot, because that enables your PE partner to take more debt, risk less of their own money, and so their multiple will be better. And that's for sure something you can look at. And then, as rational as those guys are, there's always hypes, hard markets and soft markets. So, for example, in one of my particular markets, which is insurance sales organizations, brokers or agents, we're in a clear hype. We're beginning of 24. And I think throughout the last 2 years or so, I'd say, there's been a clear hype. I don't think there's ever been the multiples we'd see today on insurance sales organizations. If you want to sell a business and you're doing insurance sales, there's been no better time in history than now. So, use those cycles. If you're in an industry that is just not looked at from PEs, it's probably not a good idea to sell to them. And one more thing, if you want to stay within the ownership of a PE company, in the company you might sell to them, there's actually good money to be made, right? Typically, you can buy some of the stock or options, and they typically double that options or so. So there's good money to be made. When they do a good exit, you will be rewarded very, very richly. You need to make the decision: do you want to stay on board, or if you sell your business, do you want to leave? Typically, if you stay on board, price is higher, and you can be rewarded. So make that decision. When I sold my very first company to a PE company, I was trying to stay, but then they did so many things different than I would have done them. It was kind of suffering for me, right? So I decided to exit just a couple of months after they took over. So I can understand both positions. Staying there and taking the next wave because 7 years later, they need to sell your business again, or just leaving them where they are and taking care of your business, your former business. Both is fine.
Yeah, so know your value proposition, but also make sure that it aligns with maybe their long-term value proposition plan, right? The business, if you're going to stay on. Really, really interesting and keen to understand. So what do you think is driving that spike of interest in those sales insurance businesses?
Well, it's capital light, right? So you don't need a lot of capital. Typically, an insurance sales organization basically doesn't even have a real balance sheet. What they do have is a P&L, profit and loss statement, but they don't own a lot of things, right? You don't have stock because you don't trade physical goods. You don't need factories or any other expensive sites. So it's a super capital light business. It's within the insurance industry, I guess it's the most scalable. Insurance companies, basically what they do is paying claims, right? So 60 to 80%, depending on the line of business, of their business is claims payment. So buy a motor insurance, I crash my car, you pay me. It's not scalable, right? Just because you grow a bigger insurance company, your customers will not cause less accidents or smaller accidents with their cars, right? So this portion of the business, is 60 to 80%, is basically not scalable. That leaves you with 20 to 40% that should be somewhat scalable. But in insurance sales organizations, basically 100% in theory at least is scalable. Of course, you need people to sell, but they can be supported by technology, so that scales. And I think those are two reasons for insurance brokers being very valuable. They do have recurring revenues, typically, at least when they're into P&C business. Life insurance is different, but P&C brokers have recurring revenue, which super easily, increases with the price of insurance. So if you have inflation and your insurance price rises by 10%, you automatically, as a broker, your brokerage commission fee raises by 10% as well. And so you just tie yourself to the insurance company and then easily go up the ladder with inflation without having to raise prices on your customers, because it just comes as a percentage of the premium. So I think there's a couple of things why for PE companies, and now also VC companies, by the way, sales organizations are more attractive currently than insurance organizations. The first wave, I'd say, of insurtechs saw a lot of what we call neo-insurers. Fully fledged insurance companies like Lemonade and others. Second, third waves, I'd call it, of the insurtech wave or universe. You haven't seen much of those fully fledged neo-insurers. Typically, those are tech companies, so building tech for insurance companies or enablers or sales companies. But you don't see many Lemonades being found in the last 5 years, I'd say.
So as a board level advisor to companies as well, including like We Group and Loanbox at the moment, can you share examples of how C-level executives in fintech and insurtech firms can fully capitalize on the experience present in their boardrooms?
I advise C-levels to pick their board members and assign roles to them. Everybody in your board should have a role. It could be a tech role, could be a growth role, could be an M&A expert role, could be a people management role, a finance role, typically, former Big Four auditor or so. Everybody should have a role. And then you need to make sure to leverage every person. I think way too few C-levels leverage the times between board meetings. I mean, in board meetings, all those people with different roles come together and there can be fantastic discussions. Don't get me wrong. But I personally think more value can be created between those meetings. When you engage in a one-to-one or one-to-two scenario with one or two of your board members with specific roles. So let's say you have an M&A expert on your board and you want to do M&A, don't wait for the board meeting, right? Engage with them. Or let's say you have the former Deloitte auditor on your board, engage with them when your annual reports. And so leverage the single persons rather than waiting for the next board meeting to happen and then have all of them at once. It's two different value creation levers, I'd say. I'm not saying board meetings are not value creating, but differently than engaging one-to-one with your board members. And I think some PEs are doing that masterfully, creating and assembling those boards from different roles. VCs typically are not. Typically, as a VC, you put one of your people into, the boards of all of your companies that you invested in. And typically, those people don't have designated roles. So I think clear difference between venture capital and private equity is most private equity companies are masters in assembling boards, whereas VC companies just send somebody there just to be on the board.
Yeah, very different approach. That's really good advice. So what's your expertise, or what do they leverage you for in your current board roles?
I typically have the growth role. So I come from growth companies, and so I typically have the growth role. I've done quite some M&As lately, so I tend to come in as the M&A guy as well. And obviously, I've exited a couple of businesses to PE or to strategic buyers. And so I typically have this exit role as well. But I'm not the finance expert. I can't tell you how to masterfully do your P&L and balance sheet statements or so. I'm not so much of a people expert of how to lead people, how to structure teams, modern ways of leading people or so. That's not my role. I'm not a legal guy. Beyond me, you typically have a legal person on the board which can help you with all the contracts and difficult negotiations with partners and customers and suppliers. So that's typically not at all my role.
Yeah, so being an effective board member is knowing how you can add value.
Yes. When I'm asked, I really ask, what's my ticket, right? And then they say, we already have 3 growth people on the board. And it's like, well, what's my role? If you have growth people, I'm a growth person. Rather engage with somebody different, that complements your board, your current board, but don't take the 4th person on growth on the board. But a lot of owners or C-levels don't really think about boards that way. I think they want some big names in there. Crafting these boards roles is an art. And again, I know a couple of PE companies who do that masterfully.
So when you're looking at potential ventures, and I know you've got some irons in the fire, what key factors do you consider to assess their viability or even their potential for disruption in the market?
I must say I'm a very bad investor. I've learned that throughout the years. I've lost a lot of money when just investing into startups or companies. And so typically when I engage economically, I typically engage also as a person. So I would only invest in companies where I have a board seat or a C-level position or whatever. When you start a company with a team, that's the same thing. What do you look for? I hear people saying it's all about the team. And I agree that the team is an important factor. But again, there's so many ways to assemble a great team and to have success as a team, right? As much as many people agree that diverse teams can outperform teams that are not so diverse team must be managed much better than your non-diverse teams. So when managed perfectly or very well, diverse teams are great. But when managed poorly, they can be a nightmare. And so it's super difficult to just tie it down to one criteria. I think that the team itself must be a good team, but it can actually be a good team can have many forms. And I think it's on you to decide. And I've done a lot of mistakes deciding for the wrong teams. I personally do look for, the topic I get engaged, obviously the team, the market potential, the idea that they have in terms of making things better. I personally am not, that's also a VC versus PE thing. Venture capitalists typically look for the next big headline exit, right? So I've been engaged in Google when they exited, or Facebook, or Airbnb, or whatever. This is what they look for. This is how they raise their next fund. PEs are happy with doubling the valuation, versus VCs always want 10-fold, 20-fold, 40-fold or so. And for them, one star is good enough potentially for an entire fund, whereas PE, need to limit their failures. Probably in my engagement or investment style, I'm closer to PE than to VC now. I don't need the big star. I don't need to be part of the next Facebook, right? I'm happy to be part of 2 or 3 or 4 well-run companies that may or may not have a successful exit at the end. I'm also happy to live from dividends from my investments, right? So I'm not as aggressive, far less aggressive than I've been, and far less aggressive than VCs are today. I'm more of a PE guy, I'd say, without the financial engineering part, which I don't understand as well as they do.
Yeah, understood. So I guess finally, Ollie, what do you predict will be the next significant innovation or disruption in the insurance space?
It's super easy to say AI now, right? Because everybody would say the same thing. And I do believe that artificial intelligence will also make a difference eventually for insurance or for the insurance industry. Again, coming from the value chain of insurance companies, if 100 is the premium you pay as a customer, let's say on average 70 goes to claims, so it goes back to you as a customer when you have a claim, and about 15 go to distribution, and the remaining 15 is cost for the insurance company, admin cost as we call it, and profit for the insurance company. I mean, most naturally, the next big thing should come from claims, and that next big thing, I mean, we can name it, but we can't handle it yet. The next big thing ideally should be prevention. Is preventing accidents or bad things, health issues, before they happen. Now, do I believe that this is the next thing? I don't believe it's the next thing. I think it will be the biggest thing that this industry will ever see, if and when we will be able to prevent bad things from happening to our customers before they happen. To warn them from before an accident happens, to warn them before a health issue happens, before they have a heart attack or so. I think that will be the biggest thing that will ever happen to the industry, but it's not happened yet. I personally tried it twice and I failed. It's super, super hard. It's changing behaviors of people. It's basically smart-assing people because you pretend to know it better. When I tell you, sorry, but you're going to have a heart attack in the next 5 weeks or so, eat differently, go to the doctor, have something. This comes across very intrusive, right? And as an insurance company, you're not in a position to intrude your customer. And so even when we are able to meaningfully predict things, the very hard thing is to get to the customer and make the customer change her or his life or habits accordingly to prevent this, right? With most claims pictures, as we call it, we haven't even mastered the prediction, but by far we have not mastered the prevention, which means altering people's behavior. That's something we haven't mastered at all yet. And so I failed both times. I tried to predict bad things and then make people change their habits, their behavior. I completely failed in that. So while this is the most meaningful disruption, I'd say it's clearly not the next disruption. The next disruption is probably technologically, it's probably AI, I guess, because that's where people are working at. That's what's being funded. And I guess it's coming from insurance sales. So making insurance sales more efficient by taking away the little everyday tasks that salespeople still do beyond advising and selling to customers. I think that will happen, and that affects about 15% of the value chain in terms of revenue. I'd love to say it's prevention, but it won't be the next big thing.
So I guess as well with prevention, you're reliant as well on the data being accurate and the customers being honest too, which is probably where it becomes more complicated as well.
Yes, there's some data you can measure, like through your smartwatch or so. You can measure data without people being able to lie to you. And so we do have plenty of input data. What we're missing is the link between this input data and the claims, the shit that happens, right? Because that typically comes in at a very different position in your company. That comes in the claims department. And so what you'd need is a personalized, which is difficult from data protection perspective, but you would need basically 1 million Ollies that unfortunately had a heart attack, but you could read out their smartwatches, 10 years back. Yeah. That's what you need, right? And you need it on a personal basis. You need to know this is the heart rate of Ollie. And Ollie had a heart attack on, the 22nd of February, 2024. But this is what his heart rate was 10 years before. Do I see any anomalies? And you don't need that once. You need that, at least 1,000, better 10,000 times, right? And the same with, and the same with lung, and the same with liver, and the same with whatever, right? And And that link is the first hard thing to do. And only few people have mastered it. Because again, it's a data protection issue, right? You can read out Ollie's smartwatch, but then linking it with his clear name to a claim that might happen 10 years later is just something that the data protection officers don't like. And in some instances, like telematics for driving, for accidents, we've done some work. We've connected the work to accidents. But yet again, then the second problem comes up, altering people's behavior. So tell Ollie or Emily to drive more carefully or not use her smartphone while driving, or don't drive that road between 9 and 10 a.m. because that's when accidents happen. It's just very difficult. Why would Emily do that, right? Just because the insurance company tells her on the app, Emily, don't drive that road, take a half an hour detour to make yourself safer. Wow, who's gonna listen to that, right?
Well, you've tried twice, so let's hope third time maybe in the future will be the charm.
Yes, that's fingers crossed.
Fingers crossed indeed. Ollie, thank you so much for joining me today.
Thanks for having me, Emily. It was a pleasure.
Take care. Bye-bye.
Yeah, bye.